Imagine, one day you're sitting in your home thinking life is perfect. You own your house, have a stable job, retirement plan is set, and then one day everything's gone. Your house, your job, and your savings, just numbers on paper, worthless. 2008, the year that changed the world. A crisis that took 8.7 million jobs from Americans. $16 trillion vanished. The biggest economic earthquake since the Great Depression. But this isn't just a story about numbers. It's a story about greed, deception, and a system that sacrificed ordinary people to save bankers. Today, we go back to 2008 to understand how a superpower's economy fell to its knees. How Wall Street destroyed Main Street, and most importantly, how all of this could have been prevented. The early 2000s setup. Our story begins in the early 2000s. The dot-com bubble had burst. 9/11s had shaken the economy. And Federal Reserve Chairman Alan Greenspan made a decision that would change history. Interest rates were slashed dramatically. From 6.5% down to just 1%. Suddenly, borrowing became incredibly cheap. Everyone wanted loans, and this is where the story begins. The story that would destroy America's middle class. Banks were flooded with money. But there was a problem. They needed customers. They needed borrowers for loans. Traditional customers had already taken loans. So banks thought, why not change the rules? Subprime mortgages, enter. Subprime mortgages. What are subprime mortgages? Simply put, risky loans. People with bad credit history, unstable income, people who traditionally no bank would lend to. They started getting mortgages, ninja loans. Heard of them? No income, no job, no assets. That's right. Banks were giving hundreds of thousands in loans to people with no proper income, no job, no assets. But the question is, why were banks making such risky loans? Because they thought they were smart. They had a master plan. The housing bubble from 2000 to 2006. America had one mantra: house prices never go down. Everyone believed it. Economists, bankers, politicians, ordinary people, everyone. Home prices nearly doubled from 2000 to 2006. A middle-class house that was $200,000 was now $400,000. Florida, California, Nevada, prices were skyrocketing. People started buying second homes, investment properties, flipping, buy quick, sell quick, take the profit. But when everything seemed perfect, nobody saw that the ground was shifting beneath them. Wall Street's securitization scheme now. Here's where the real magic happened. The magic that turned a housing problem into a global financial crisis. Banks thought, we've given loans to hundreds of thousands of people. But what if they default? What happens to us? So they came up with a brilliant idea: securitization. Listen carefully. A bank gave you a $300,000 home loan. Now that loan is an asset for the bank. You're making monthly payments. But the bank thought, why not sell this asset? Banks bundled thousands of mortgages together. Good loans, bad loans, subprime loans, all mixed up. Then they chopped them into different pieces. And then sold them to investors. They called them mortgage-backed securities, MBS. The rating agency scandal, and the funniest part? Rating agencies, Moody's, Standard & Poor's, gave these risky securities AAA ratings, meaning safest investment. As safe as government bonds. Why? Because the rating agencies were being paid by the banks to rate their own products. Talk about conflict of interest. So pension funds, insurance companies, international banks, everyone thought these were safe investments and started buying. Wall Street firms made billions from this game. Bonuses were in the millions. CEOs were flying private jets. And they were laughing because they distributed the risk across the entire world. Even if mortgages defaulted, so what? They'd already sold the MBS. Now it was someone else's problem. The collapse begins, 2006. The turning point. Housing prices stopped. For the first time in decades nationally, prices weren't rising. And then they fell. People who couldn't afford their homes started missing payments. Subprime borrowers defaulted first. When adjustable rate mortgage interest went up, people were shocked. And then the dominoes started falling, one after another. And nobody could stop it. Banks started foreclosures, taking homes back from people. But the problem was, the market was already flooded with houses. Supply increased, demand fell. So prices dropped more foreclosures, more price drops. A vicious cycle. By 2007, the situation was clear. This wasn't a housing correction, this was a crisis. The big failures. March 2008. Bear Stearns, an 85-year-old investment bank, collapsed. Overnight, JP Morgan bought it for $2 per share. Remember, a year earlier it was $170 per share. July 2008. IndyMac Bank failed. With $32 billion in assets. Lines formed outside branches as people rushed to withdraw their deposits. And then came that day. September 15, 2008. Lehman Brothers, a 158-year-old institution. $600 billion in assets, filed for bankruptcy. The biggest bankruptcy in Wall Street history. Panic. Pure panic. The financial system freezes. Same day, Merrill Lynch made an emergency merger with Bank of America. Otherwise, they would have failed too. Next day, AIG, the world's largest insurance company, was about to collapse. The government gave an emergency bailout of $85 billion. Overnight, stock market crash. The Dow Jones fell 777 points in one day. The biggest single-day drop at that time. Credit markets froze. Banks stopped lending to each other. Everyone feared the other would fail. Trust. Completely gone. Companies that relied on short-term loans for payroll couldn't get loans, meaning they couldn't pay salaries. The auto industry was dying. GM and Chrysler were on the edge of bankruptcy. This wasn't just a financial crisis anymore. It became an existential threat to the entire economy. The human cost. Now forget the statistics. Forget the numbers. Listen to the real stories. 8.7 million Americans lost their jobs. But this wasn't just a number. These were real people, families. When Wall Street played roulette, Main Street paid the price. Millions of foreclosures. People received eviction notices. They had to leave homes they'd bought with dreams, where they'd raised their children. Neighborhoods became ghost towns. Every third house had a for sale sign, but no buyers. Destroyed FUT's retirement savings dropped 40 to 50%. People close to retirement had to work 10 to 15 more years. Some never retired. College students graduating in 2008-2010 couldn't find jobs. They were called the lost generation. Their lifetime earnings remained permanently lower. Unemployment crossed 10%. Youth unemployment? Over 20%. Imagine 1 in 5 young people couldn't find work. And the most tragic part? Those responsible, Wall Street executives, rating agency officials, mortgage brokers pushing fraudulent loans. Many of them never went to jail. They kept their bonuses, took golden parachutes, and moved on. The bailout October 2008. The government had to make a decision that would remain controversial in history. TARP Troubled Asset Relief Program. A $700 billion bailout package. Taxpayer money. Understand this. The same banks that created this crisis were being saved with public money. Perfect example of moral hazard. If you know the government will save you when you fail, why would you be careful? But officials said, if we let these banks fail, the entire financial system would collapse. Great Depression 2.0. The Federal Reserve dropped interest rates to almost zero, started quantitative easing, printing money. Recovery began. But it was slow, very painful. The lessons 2008 proved one thing. When greed meets lack of regulation, destruction follows. The lessons are clear. 1. No institution should be too big to fail. If it is, break it up. 2. Financial products that common people can't understand shouldn't be mainstream. 3. Conflicts of interest are dangerous. Rating agencies shouldn't be paid by the banks they rate. 4. The housing market can't run on eternal growth. Bubbles eventually burst. The reforms in 2010, the Dodd-Frank Act passed. Reforms. More regulations on banks. Higher capital requirements. The Consumer Financial Protection Bureau was created to protect people from predatory lending. But the question is, was it enough? Did we actually learn from this crisis? Today's a real ITY today. Some things have changed. Some haven't. Banks have gotten big again. Inequality has increased. And the financial system has become complicated again. CLOSING. So the question isn't whether we're ready for the next crisis. The question is ... have we actually learned anything? History repeats itself for those who don't learn from it. The 2008 financial crisis didn't just crash markets, it crashed lives. It crashed dreams. It crashed trust. And the scars? They're still visible today. Thank you for listening. Remember this story, because the moment we forget is the moment we're doomed to repeat it.